cost of living is going up fast, right? We have hot inflation. Just the cost of financing is going up, right? Mortgage rates have pretty much doubled since last summer, right? And seem like they're going to go even higher from here. And that would be okay if their wages were keeping pace, but they aren't. Real wages have been going down for the past 2 years. In fact, they've decreased, I think, in every one of the past 13 months, right? So people are just able to afford less and less and less. And the reason why this is so important is you and I have talked about a lot. In housing, what really matters is the marginal buyer, right? Is the person that is showing up to buy the next property, are they willing to pay those current prices? Are they willing to bid higher for them? Or can they only afford to pay something lower? And the reason why the marginal buyer matters so much in housing is because you have a neighborhood, if all the houses are roughly similar, the market value of all of those houses is determined by the last transaction that was made, right? You only need the next buyer to only be able to pay 80% of the price for all homes to go down 20% in value, right? So
that's right.
What are you seeing right now as you sort of look at the marginal buyer in a lot of these markets? I mean, I guess you mentioned that we're seeing more price declines and stuff like that, but are we beginning to see the marginal buyer buckle here?
Yeah. I mean, the marginal buyer for like the regular homeowner, I mean, they're okay. I want to draw a little bit of a distinction here. The marginal buyer is a regular homeowner on homes above, let's just say $500,000, on average, they're gone. Like the higher end of the housing market right now, homes that are more expensive are sitting on the market for weeks, for months. They're cutting the price. There is still a certain level of demand at the lower price point. You get to a $300,000 home or a $400,000 home. Actually, because the mortgage rates have gone up so much, that pushed the 500,000 buyer into the 400,000 bucket. So we are still seeing some strong demand in certain markets at that like affordable starter home type price point. However, I think at some point that demand is even going to start to evaporate as well as more and more people realize the housing market's going down. They're not going to want to buy an asset that's going to depreciate in value right after they buy it. There's another headwind also, though, going on for that marginal buyer, and that's that we're starting to see investor demand in the housing market take a hit. This is something a lot of people aren't talking about. Like I still see news articles talking about like, all the investors are buying up homes in Florida and Arizona, which is still happening. But we're starting to see a drop in investor demand. We originally saw this in December 2021, right at the end of 2021, there was a drop in investor demand. That looks to be continuing so far this year because it turns out, even though investors buy in cash, they actually are pretty interest rate sensitive. Because even when they buy in cash, the source of that cash is often a credit facility from a bank that's floating rate. So you increase the short-term interest rates that increase the cost of borrowing. So I think this is going to be the next big story in the housing market over the next 3 months that you're not hearing about now, but you're going to hear about, is that the investor buyer is going to, number one, drop out of the market to a big extent, return to pre-pandemic levels. But the number two, the investors are going to turn to sellers. And that's another domino on top of what we're seeing right now, especially in a market like a Phoenix or a Vegas or in Atlanta. These markets are dominated by investors. And
right. Well, and the investor has an itchier trigger finger, right? So you have some big funds that own tons of properties, and yeah, maybe they can hold on for longer. But if it's a mom and pop investor, right, where you only have one or two other investment properties, and you're beginning to get nervous about your financial situation, one of the easiest things to do is just say, well, we're just going to put that thing on the market, right?
Great point. Is the investor is looking at the home as a profit center, right? A regular home buyer is looking at the home as a place to live. So a regular home buyer, if for instance, like a market has more regular home buyers, like a Milwaukee, it's going to be more stable because there's less of these people buying and selling who have an itchier trigger finger, as you say. If a market is 30+% investor purchases like a Phoenix, or in Atlanta or Jacksonville is another big market where there's a lot of investors. That market has so much downside that it's hard to see in the moment. But like these investors, they all kind of change their mind at the same time. Like you said, the smaller ones are going to sell first because they say to themselves, well, my cash flow yield is actually pretty low. Something a lot of people don't know. The rental yields in today's markets are at record lows. So it's not as if people renting their properties out are earning great returns.
Interesting. So, and I'm just curious, why is that? Because I think we just figured we did it because they were minting money.
Yeah, they did it because the Fed was artificially lowering interest rates, and basically that lowered the return hurdle for an investor. So if the 10-year bond is 1.5%, like I think it was maybe 18 months ago or 12 months ago, that makes earning 3% on a rental kind of attractive. But if the 10-year bond goes to 3% like it is today, well, then earning 3% on a rental isn't as attractive.
Yeah, and that's a fantastic point.
So that then turns the return expectations more to appreciation, right? If the cash flow yields are lower, it's going to be more of an appreciation return expectation. And once the appreciation starts going down, there's no incentive to hold.
Right. And sorry to interrupt you, but I believe, and correct me if I'm wrong, there's an incentive to sell. In other words, to be a first mover.
Yes, 100%. You know, you don't want to be the last person on the block to sell.
Yeah, after the price has already come down, right? Yeah, exactly.
Right.
You want to be out.
Yeah. So the psychology in the housing market is really turning right now. And you made a good point. The smaller investor is going to be the first one out, and they're already out or going out of the market as we speak. But there's a potential bombshell with the bigger investors that no one's really talking about. And that's that these bigger hedge funds and private equity firms that raised oftentimes billions of dollars to buy homes. These funds are buying homes right now at sky high prices and record low rental yields. And they are not, I'm almost positive they're not making money right now on these assets. They're banking on continued appreciation and rent growth. Pay attention to the rent growth, because that's been going up in America over the last year. It's starting to slow. And as the rent growth slows, all of a sudden, a lot of these big investment funds that basically promise their investors and promise the banks who are funding their credit lines that they were able to grow rent by 5 to 10% a year and make them money, they're going to realize that's not happening. And right now, the 4 worst rent growth markets in America where rents haven't grown the last 6 months are Phoenix, Vegas, Jacksonville, Atlanta, which also happen to be the biggest corporate investor markets.
Interesting.
So as the rent growth is slowing, they're not going to be able to increase their yields. And then, oh yeah, majority of the capital for these plans is coming from bank credit facilities that are floating/adjustable rate. They float over the short-term interest rate. So every time the Fed hikes the short-term interest rate, that increases the cost of borrowing and financing these acquisitions. So this is a potentially like devastating combination where I think we could see not only these big investors stop buying, I think we're going to see some of the banks funding these credit facilities, which are banks like Goldman Sachs and Wells Fargo, say, liquidate. Like,
yeah, you're cut off. Yeah.
Margin call. You're going to need to pay us down by 20% because the market has shifted. And when that happens, all bets are off. And so right, I don't know exactly how that's going to play out or if it's going to play out like I'm saying, but it's a risk factor that I think in certain cities could be equivalent to the subprime crisis, but it's obviously not quite working the same way. But,
right. And I can understand the logic of that, right? So, these big funds that have hundreds, thousands of properties in a metro area get in trouble and they just have to dump a ton of inventory on the market at once. And they're almost kind of price insensitive on what it sells for. We just need to get something for it, right? We have a margin call to meet or whatever, right?
Yeah. And so back to your point, who's the marginal buyer when investment firms are dumping properties on the market and then not buying them? I mean, that's crazy. And yeah, so that's a risk factor that, it's me speculating. I want to be clear, but it's a risk factor that's definitely there.
Yeah. And what's important about that is it's a new risk factor, right? It's one that we don't have a lot of history of going through a potentially substantial real estate downturn with a good chunk of the inventory held by institutional investors.
Yeah, like this, right. Never before has this happened. And again, it's almost consistent with a lot of the other things we saw during the pandemic. It's like on the upswing, these things were used as a justification to say why prices would continue going up. Like remote work, that meant to a lot of people that prices would keep going up in Sunbelt housing markets, or the investors buying meant the prices would keep going up. But when these trends revert, it's almost like they will cause the downturn to be worse.
If you enjoyed this video clip, click here to watch another one you should like.